The play, The Merchant of Venice, published by the famous English writer William Shakespeare, features one of the most significant characters in English literature, Shylock. During the Middle Ages and beyond, Jews were deeply hated in Europe to the point where some cities marked them with specific colors and forced them to live in designated areas of the cities, known as the Jewish ghetto. Why did this happen? Why didn't they just expel them? Venice, for example, recognized the importance of Jews. Although they were hated, they were crucial to the country's financial system. Let me explain why. Christianity forbade Christians from lending money to other Christians with interest. However, for Jews, lending money to Gentiles with interest was allowed without punishment in the afterlife. This was reason enough to keep Jews in Europe, despite the widespread hatred towards them. Thus, they became money traders in Europe. The key point in the story is that a young Italian man, Antonio, borrowed money from Shylock, a Jewish moneylender, to help his friend expand his business. Shylock agreed to the loan on the condition that if Antonio couldn't repay it on time, he could take a pound of Antonio's flesh. Unfortunately, due to unfortunate circumstances, Antonio lost his ships and couldn't repay the debt. The matter was taken to court for Shylock to claim his agreed-upon rights. Antonio was a young, hard-working merchant in a society that didn't strongly believe in taking loans to grow businesses. Let me explain why. Let's compare wealth to a cake in the eyes of people back then. Each person takes a slice, and if you take a larger slice, you're taking someone else's share. The cake exists, and its size is fixed. Many religions held this belief. The richer you became, the more you were taking from someone else's share, because the existing cake was seen as limited. This concept of a fixed and limited cake had a significant impact on the thinkers of that time and beyond. The English thinker Thomas Robert Malthus discussed the idea that the economy heavily depends on population size, with an increase in population leading to an increase in agricultural production capacity, but he predicted a bleak future because, since the cake's size is fixed and doesn't change, even if it grows, it wouldn't grow at the same fast rate as the population. This would lead to poverty and famine, which would, in turn, lead to wars over resources. People at that time believed there was no need to invest your gains or those of others to grow your business. There was no need to take loans, because you would be taking someone else's share, and it was also against the teachings of their religion. Additionally, the future seemed bleak, and the size of the cake doesn't change. However, subsequent scientific advancements, agricultural and industrial revolutions changed this narrative. In China, for instance, with the use of fertilizers, it was realized that crop yields could be increased to feed more people. As tools developed, we became able to produce more resources with fewer people. It seems that the cake actually started to grow, and so did the number of people benefiting from it. Between 1750 and 1850, the global population increased by 500 million people. From 800 million, it jumped to 1.3 billion. By 1960, we reached 3 billion people. After that, the number increased by 1 billion people every 15 years, and wealth increased. The cake itself grew. In the 16th century, global production was steady at what today would be valued at $250 billion, whereas today, it exceeds $100 trillion. This wasn't just because the population has increased. Even when you measure it on a per capita basis, it went from $500 to $8,000 per person, meaning individuals became more efficient. Production is no longer directly tied to population size. It's clear that the cake began to grow, and people began taking larger slices. Not only that, but individuals also started feeling that their share of the cake is not only growing, but will continue to grow and grow. This is where moneylenders like Shylock come into play. This belief, coupled with technological advancements, fundamentally changed the course of life on the planet. Imagine the following scenario. David has just opened a new bank, which has no customers yet. His first client is John, a construction contractor who has just completed building a house and received a payment of $100,000. John deposits this money into David's bank. Paul, a budding investor, is looking for business opportunities and notices a neighborhood that lacks restaurants. He decides to open a restaurant there. Paul approaches John and asks for a quote to build the restaurant, just the construction costs, not the entire budget. John says his fee is $100,000. Paul has the budget for the construction, but not for John's services. He goes to David, the banker, to borrow the amount. David agrees, convinced that the idea is profitable. So David lends Paul the $100,000 that was already in his vault. Paul goes to John to start the project and pays him his fee. John takes his money and deposits it back into David's bank to keep it safe. What is John's balance now? $200,000. Do you notice something? Doesn't it seem like money has been created out of nowhere? There was only $100,000, and now it's $200,000. This process can be repeated. Let's say Paul wants to make necessary changes based on market trends, and John asks for another $100,000 to make these changes. Paul finds it difficult to stop now, because he is stuck in the project. So he goes to David and asks for another $100,000. The bank grants his request, and Paul gives the money to John. John deposits it into his bank account, bringing his balance to $300,000. Yet, there is only $100,000 circulating in the system. Some studies suggest that banks in America perform this process up to 10 times. This means that for every real dollar in the bank, there are 9 virtual dollars. This explains why only 10% of money is physical cash, while the rest exists as numbers on screens, promises. The idea is that the bank is confident not all customers will come to withdraw all their money at the same time. So, there's no harm in lending more to make the cake bigger because the money will return to us in the future. Let people borrow, start their projects, and make money, and they will inevitably pay us back. The bank has become somewhat confident that the future will be bright. The money it lends isn't always from its actual reserves, but it will come back to the bank. Even if there are problems and economic crises, the continuous advancement in production will eventually fix the issue before the bubble bursts. Then, the debt bubble began to take another turn. Since we know the future is bright, why not encourage people to dive deeper into it? Why invest in a project and live in a small apartment? In a few years, when your project yields profits, you'll buy a bigger apartment. So why wait? Get it now. Dear subscriber, you might wonder, what guarantees the success of borrowers after those years? Frankly, our statistics and records often indicate that. Societies are becoming increasingly wealthy. Even those who were considered poor are financially better off than before. For example, if we say the poverty line is 1,000 international dollars annually, the international dollar, also known as the Gary Kamis dollar, represents what you can buy with $1 in the United States. If, for instance, a loaf of bread costs $1 in the US, but costs 2 Canadian dollars in Canada, it means that 2 Canadian dollars equals 1 international dollar. This is a calculation of purchasing power, not the exchange rate. The key point is that in 2003, the percentage of people living below the poverty line was 48%, while in 2013, it dropped to 29%. These statistics refer to people earning less than 5 international dollars a day. So, the number is decreasing. This made many financial institutions optimistic. People are getting wealthier and conditions are improving. As a result, the debt trade kept growing and growing. One of the causes of the 2008 economic crisis was something called subprime mortgages, which are high-risk mortgages. Essentially, they were giving loans to people with a low likelihood of repayment, based on optimistic statistics and projections showing that people were getting wealthier and property prices were rising. Banks did not consider it a matter of concern to grant these loans. Gradually, selling debt became more profitable than selling products, as the future was seen as larger and more lucrative than the present. However, this turned the world's biggest lenders into debtors, because, as we mentioned, banks were lending money that wasn't always their own. In 2008, we witnessed the fourth largest investment bank in America, Lehman Brothers, declare bankruptcy after failing to repay a debt of $600 billion. This amount is larger than that of a country like Greece, which defaulted on a debt of $138 billion. Imagine an American investment bank defaulting on debts larger than those of an entire European country. These are huge sums. In some cases, banks had debts larger than the debts of the countries they operated in, and even larger than their gross domestic product. For instance, Iceland's GDP was $13 billion, while the losses of just 3 of banks there amounted to $100 billion. The bankruptcy of a giant bank like Lehman Brothers led to the bankruptcy of other banks because they were part of a network of banks dealing with each other. This collapse caused several stock markets to crash, and led to recessions in multiple countries. The debts of the lenders didn't just bankrupt them, they also bankrupted many others. The bright future that these enormous debts bet on collapsed on everyone's heads. In summary, humans have long believed that life is harsh, and the future is bleak because the population keeps growing, and resources are limited. But after the scientific and technological revolutions, the cake that people were eating from began to grow, and people started to believe that the cake would continue to grow even more. Greedy financial institutions encouraged this belief, being the biggest producers of debt. Now, all countries are in debt, even the largest and wealthiest. Debt has become an essential part of our institutions' lives. Throughout history, debt has always been part of societies and individuals' lives, but in our time, these institutions have become incredibly large. I'm not saying this is a bad thing, but I want to point out that this system has provided short-term benefits while creating long-term risks. It's crucial to study these entities deeply to understand how they impact the global economy and how to manage the risks associated with them. That's all for this episode. This was Nova on the Nova Briefcase channel. Don't forget to subscribe, like, comment, and share. I hope to see you in the next episode. Goodbye.